You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. It is a dangerous world out there. Volatility is on the rise, and your clients' portfolios are under assault from a growing number of threats. Simple diversification is no longer enough to shield the assets under your protection. Registered investment advisors, financial planners, and asset managers need a new weapon in their war on risk. Welcome to the Advisor's Option, the program designed to arm busy advisors with the information necessary to properly manage risk in this volatile environment. From options education, trading strategies and tips, to industry news and interviews, you'll find it all on the Advisor's Option. The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Option Research and Technology Services. ORATS is your source for options backtesting. It's where you turn your ideas into results. Founded on the floor of the SIBO over 2 decades ago, ORATS is a full-service option research firm focused on helping you develop options strategies in line with your investment objectives. With a state-of-the-art backtesting platform, scanning, and implementation tools, ORATS offers end-to-end option strategy development, making the whole options trading process easier. For information about backtesting, scanning options data, including dividends and earnings, visit ORATS.com or email Matt Amberson at matt@orats.com. And now, it's time to learn how to implement options in your practice. It's time for the Advisor's Option.
All right, everybody. That music means we are back once again for the Advisor's Option, the program here on the Options Insider Radio Network for you, the busy financial advisor or asset manager. Maybe you're out there busy trying to hold your clients' hands through these troubled times. I wouldn't blame you. These are demanding times for everyone. So who has time to learn about these options things, to keep up with all the latest developments in the world of options and derivatives, do a little bit of education? Well, guess what? We do. We got you covered here on the Advisor's Option. My name, of course, Mark Longo from theoptionsinsider.com, as well as, of course, from the aforementioned network. And, of course, if you like what you hear, do keep rating and reviewing it. Wherever you get this content, it's available pretty much everywhere under the sun. So just about every outlet on the planet these days seems to carry it. Even your smart speaker or your YouTubes. You name the platform, it's there. So if you like what you hear, if they do provide a rating function, do keep doing that. Every month this year has been a busier month, a new record for us. We've been doing this for a while, 15 plus years. So that's saying something. So if you like what you hear, do keep rating and reviewing. It clearly does help new people continue to discover the content. And there are clearly a lot of financial advisors out there who are intrigued by all things options and need to learn about the show. So if you like what you hear, do keep rating and reviewing. Of course, if you want to go above and beyond, participate in our great pro Q&A sessions, our unusual activity, live streams, giveaways, a whole bunch more. TheOptionsInsider.com/pro is the place to go to learn more about all that. And let's learn who's going to join us on the show today. First, I am pleased to say we are joined once again by my cohort and compatriot in all things Advisor's Option crime, Mr. Matt Amberson, the founder over there at ORATS, a.k.a. Options Research and Technology Services, what we call them around here at the Oracle of New Hampshire. Mr. Matt, welcome back to the Advisors Options, sir. It has been too long.
It has been too long, Mark. Good to be back. Yes, some exciting stuff to talk about.
A lot of exciting stuff. And joining us in the hot seat to help us break down all that exciting stuff is a newcomer to the program and indeed to the network. He is Nick Griebenow, the portfolio manager over there at Sheldon Capital Management. Nick, welcome to the Advisors Option program.
Thank you, Mark. Thanks for having me.
And Nick, as we are wont to do with all of our first timers here on the network, why don't you go ahead and give our audience a bit of an overview of your background in the options and derivative space, as well as what it is you do day to day over there at Sheldon Capital Management.
Absolutely. So yeah, I guess started my career, a number of years ago with Charles Schwab and very quickly worked my way onto their options trading desk. That was before they had integrated Options Express. So they brought on futures later, a little bit after the fact there, but was on the options and futures trading desk, spent a lot of my time doing education. I took lead in creating Schwab's nationwide options trading training curriculum that they put brokers through to join the options desk. So spent a lot of time teaching, a lot of time trading on the most active derivatives trading team at Schwab, and then moved over to Shelton Capital about 5 years ago. And I'm a portfolio manager on our options overlay strategies here. So I spend most of my day trading options or monitoring for, assignment risks, good trade opportunities, those kind of things. So most of my day is spent behind streaming chains and Excel and looking for things to trade.
There's no shortage of things to trade right now, so let's get to it with the P&L statement.
What the heck happened in the options markets since our last episode? Let's find out with the P&L statement.
All right, everybody, welcome to the P&L statement, the segment that was born of the pandemic because we found ourselves on pretty much every episode of the show spending a whole bunch of time talking about what the heck just happened in the market because so much crazy stuff is happening literally every week these days. So now it is codified into its own segment. Hence, the P&L statement was born. And Mr. Nick, as our guest, we will start with you. Obviously, a lot going on out there in the markets. We're rallying. We're selling off. We're kind of hovering around 4,000. Now we're kind of selling off away from it a little bit again. Vol was looking frothy, looking turbulent. Then Vol has continued to erode. Asset classes moving in lockstep. Dogs and cats living together. Mass hysteria. A lot of craziness out there in the markets. What's been lighting up your tape out there these days?
Absolutely. I think, main thing lighting up the tapes for me, or main thing I've been noting is valuations that are coming back down from where they had been. I think after the last number of years here, especially with the easy money policy from the Fed, we had valuations getting quite stretched. Now that we've come back down out of the clouds a bit here, obviously it's been a really volatile year, really choppy year, but now that we've got the 12-month forward PE on the S&P back down in the 17s, we're back at least within reason. I think we had gotten a bit ahead of ourselves there, and then volatility has been down and coming down here after the peak that we had there in early October. But I think the notable aspect of volatility so far this year is that it seems that the VIX and IV hasn't quite kept pace with realized volatility in HV so far this year. So that's been a notable thing where we've had some pretty sizable moves in the equity markets. And while we've definitely got an elevated VIX, had some volatility spikes here, it hasn't quite corresponded or I guess kept pace with that realized volatility. So still seeing a bit of an IV dampening here compared to what we would have expected.
And Mr. Matt, same question for you, sir. Obviously a lot going on. We were rallying. Now we're selling off again, even though we are still not that far away from that 4,000 level in the S&P that we seem to be glued to for quite some time. Vol was frothy, was elevated these days. Not so much back into the low 20s range. Both of those things are actually the subject of recent questions of the week, recent audience polls we've done here with our social media audience. We'll get to that a little bit later in the show, what they're feeling about this market and about volatility. But Mr. Matt, before we get to that, what are you feeling about this market and about these volatility levels, sir?
Yeah, it's nice to have Mr. Griebenow on because he reminded me to look at a couple things. I just pulled up our charts on our dashboard and looked at what the HV divided by the IV was. And yeah, he's right. Back in August, it hit a high of 1.5 IV. So IV was overvalued for a while, but it's been under, and now it's about even with the trailing 20 days, so IB30. So, yeah, that's interesting. Yeah, we have like was mentioned, IV has been coming down since October. We watch that closely. We look for a break in the trend line, but there hasn't really been one. So that downtrend is usually indicative of a pretty strong market. It does look like it's getting up near the trend line. We, as been on many times talking about that. We look at that. We look at how the contango is looking. Contango is all screwed up with the election and other things, and then it drifted up, but it's coming back down. So that's a little bit bearish. We have these forward volatility indicators that have been looking pretty decent. That they actually look somewhat strong. So I'm kind of mixed on my on the market right now. I'm a little, they're not really bearish signs, but the bullish signs are weakening a bit. I think it's interesting how the put skew, it was as low as we've ever seen it back in early this month, and we're still in November. So early November it was just very low, and now it's creeped back up a little bit, but still low. So I think this is the most anticipated bearish move that hasn't really happened, is how I would term it. Everyone's loaded with puts, everyone's short that needs to be short, and I think that's why the market's kind of drifting up, climbing a wall of worry, as it were. And yeah, I agree that valuations. I foresee value. It's usually about 12 months after this aggressive hiking when you see earnings start to come down precipitously. So earnings in the S&P are about 222, I think I read, and then if that comes down to 200, which is a big move down, and you get a recession multiple of I think the average is 14 to 16 in a recession. So if you get 15, that's 3,000. So that's what I'm thinking. Mayish or early summer, 3,000. I think we'll be down in the 3,000s. But until then, I think like I said, we could be rallying a little bit just because so many people are bullish, and earnings I think are going to drive this thing, and we're not going to get much in earnings, with earnings season basically over. I think we're going to get some more hawkish talk from the Fed tomorrow. And what is it, a 30%, 75% basis point hike odds? It's probably going to be 50%, 50 basis points. And I think we'll kind of rally off of that a little bit, actually. So if it's 75, we're going to definitely dive. But, it's probably going to be 50. And there's this, the market's bumping up against a pretty strong upper resistance trend line that's pretty strong. It's been hit a few times. So, I think a lot of people have stop losses above that. So if we punch through that trend line, I think we're going to be up, a few percent until we finally, sometime next summer we'll be down in 3,000. So that's a mouthful, but that's what I'm looking at, Mark.
So put skew is low, Matt. So buy all those puts. That's what you're saying. Gobble them up to cheap.
Well, actually, that's a good point. What I'm seeing is I think we're in a much different market now. Whereas I used to buy just those long, cheap, out of the money puts that used to, pop when the market went down. I think we're in a bearish market now, where the volatility actually goes up when we rally hard. So it's kind of a weird market. So I'm doing more put spreads and put calendars, because I don't think we're going to get that, even though, the skew is pretty cheap. I don't think we're going to get the big pop on the down moves. So if that's the case, you don't want just pure puts, or they're not going to be as profitable. That's why I'm looking at put spreads and put calendars, because I think the protection is going to be mitigated. I don't think we're going to get that big volatility pop that when the market goes down. I think it's kind of predicted, and I think the market will kind of make a gradual and predicted move down over the next 6 months. So I don't think we're going to get that big vol spike, Mark.
That isn't too sexy for all the put buyers out there. So it's maybe a Cyber Monday sale on puts right now, but maybe be a little bit reluctant to gobble them up. You might be tempted, but maybe keep your powder dry out there. Nick, Matt brought up a lot of great points, including the notion of the vol surface, the VIX term structure out there. It's a leading indicator for a lot of people. It's one we watch very closely on our Volatility Views program. I've often joked many times on that program that the answer to all of your market questions is lurking somewhere on that vol surface. You just have to find it. Is that a big indicator for you over there, Sheldon? You guys spend a lot of time looking at the vol surface out there?
I wouldn't say that I spend too much time focusing on the vol surface. I think that, especially when we're looking at farther duration options and the volatility farther out there, everything that I'm trading is pretty much short duration, going to be driven by, company specific news. Certainly, overall market environment is going to impact things as well. But yeah, I think that the overall vol surface isn't as big a focus for us as kind of shorter term aspects of the market and aspects of volatility, things that are causing pops, good trade opportunities. Fedman is coming out. That's causing IV pops on the short term options. So a little bit more short term for us than that.
And, Nick, one of the big complaints we've heard about people pretty much all year, the old refrain for the market is that when it all hits the fan, correlation goes to 1. And we have seen a lot of that across many asset classes throughout most of this year. We saw the major equities selling off. We saw fixed income selling off. We saw gold and precious metals areas where you're supposed to maybe have some protection, some flight to quality. A lot of those selling off or at the very least underperforming dramatically. Of course, crypto, some people thought of that as at least perhaps an uncorrelated asset. They have all been proven wrong. It has sold off as well. So it's very hard to find a safe haven out there these days for your clients, Matt. I know it's also challenging for a lot of people when these assets are moving in lockstep across a variety of different asset classes. Is this something you guys have noticed over there at Sheldon? And is this a big issue for you folks right now?
Absolutely. It's certainly something that we've noticed. And I think that it's an issue for advisors and investors across the board. I mean, they're, like you say, no real safe havens at this point, nowhere to go with money where everything's kind of falling, everything's bleeding. It's kind of just red across the board at this point. And I think folks need to keep in mind the long-term goals that they have. This looks to me like a decent buying opportunity to get into markets. Whether or not we have further to fall, just like you said a moment ago, maybe we're at lower end of the 3,000s coming into next year or in the middle of next year. There certainly could be more room below us, but we're well off of highs. Multiples have come back to within reason. And if you're trying to pick the perfect bottom, that's very difficult to do. Sometimes you got to look at it and kind of take a sale, take it with a grain of salt. Keep in mind that we're here for the long term. And I think on top of that, folks are starting to realize, the value of hedging in a manner of speaking. We were in such a kind of easy money era for such a long time with double-digit % returns on the S&P year after year to now we're finally seeing this volatility come back, seeing the market on a bit more shaky footing. And I think it's highlighting the value of hedging, of managing your exposures, managing that risk. And hopefully people will find some good buying opportunities here as well.
Wait, Nick, so you can't pick exact market bottoms? I was told that's why you're on the show today. Oh, we need to change the entirety of the program around. You threw us a curveball here. Luckily, we can move and adapt here. We can roll with the punches, Nick. All right, Mr. Matt, same question for you. This has been an interesting area for a lot of people. We haven't crunched the numbers yet officially. We usually do that at the end of the year on our TWIFO program, looking at the cross-asset correlation across everything they trade over there at CME, which, as you know, is pretty much everything. But you don't need to crunch those numbers to know things have been moving in lockstep for quite some time. What are your thoughts on that old adage, when it all hits the fan, correlation goes to 1, and the challenges it's posing for a lot of the advisors and asset managers out there now?
Well, first of all, correlations are a good signal. So we use that. We have this, like XLY_C, SPY_C. So it's all of the components and all of our readings and indicators and volatility measurements. So we could do a ratio of a lot of these different volatility measurements and see what that correlation is getting to be. So that's a really interesting thing to look at. Also, one of our signals, we have these now signals, intraday signals, 1 minute signals. So, and we can back test them. So it's been a lot of fun incorporating all those into our front end. The other thing is, if you think about it, so and what I've noticed is, let's just talk about like the diamonds and the SPY. The diamonds have lower volatility than the SPY, but when the whole market goes down 10%, the diamonds are probably going to go down near 10%, and the SPY might go down a little bit more. So the betas go to 1 a bit too. So what you could do is you could get cheaper puts and cheaper protection in lower volatility assets, if you think that's the case, and that's one of the things that I like to do. So I'm not buying puts in IWM. I'm buying puts in the diamonds and some lower vol stuff, and that's been actually working pretty well. So that's my take on correlation, Mark.
Interesting stuff. We'll have to leave it there though, because it is time to keep on rolling. It is time for the Options 101 segment.
It's time to learn how to manage risk and generate additional income for your clients. It's time for Options 101.
All right, everyone, welcome to Options 101. Like the man said, this is the portion of the show where we take some time to explain and discuss and perhaps dissect some basic option strategy or technique and explain how you can utilize it in your clients' portfolios. And, you know, with Nick on the show today, it seemed like a good time to do a bit of a refresher on overlays. Portfolio overlays is an interesting category. You've probably heard it, listeners, if you've been to a conference or an event. You heard someone, maybe you went to a trade show and you heard someone talking about putting overlays on your clients' portfolios. You know, we used to talk about these a lot on the show. We used to have the Swan folks on the show, obviously, all the time. They were very active in the overlay business, but it's been a while since we've gone back into those waters. It's interesting times. A lot of folks are clearly concerned about valuation right now, so it's also perhaps a suitable time to revisit this very interesting topic. So, Mr. Nick, we'll start with you as our guest. You spend your days when you're not talking to us in this wild and woolly world of overlays. So let's start there. For maybe an advisor who's tuning into this show for the first time, they don't know what the heck we're talking about. What is an overlay, Nick? What are we doing?
And so an overlay is just whenever you overlay derivative positions on top of an existing portfolio of assets, typically to, manage those exposures either by, monetizing volatility, protecting downside, et cetera. So it could be anything from a covered call, buying protective puts, buying index puts against a portfolio of equities, doing equity callers, stock repairs, anything where you're using derivatives to kind of manage and adjust the overall exposure of a portfolio or portfolio.
You kind of just mentioned the three most common buckets we tend to use when we're talking about overlays here on this program and for most of the industry. It is, as you just mentioned, the covered call. So, of course, they're out there in the income generation bucket. They're trying to add a little bit more juice, a little bit more pizzazz, a little bit of an income stream to an existing, let's say, long equity portfolio, or the one that may interest a lot of people right now because they're a little bit spooked. Matt was just talking about how puts are not quite as expensive as you might expect, but we did give some caveats there. Listen to the start of the show there before you go diving in, loading up on all those puts. So, of course, the protective put is also a very common overlay. And then you have the combo of the two, which is the collar, which is, of course, buying that protective put, selling that covered call, putting it all together in some sort of lower cost protective alternative with a variety of different flavors you can do with that. Nick, would you agree those are the three most common buckets? And how do you folks over there at Sheldon, how do you typically construct each of those buckets?
Yep, absolutely. I would certainly agree. Those are the three most common buckets for an overlay. And as far as the structuring, most of what we do is focusing on covered calls, looking for cash flow generation. So, essentially with a covered call strategy, you've got a number of different choices in front of you as far as how many shares to cover, what portion of a position to cover. You've got to balance out with your cash flow target, decide on the duration, everything there. So we're typically looking to stay fairly short duration. On average, the options that are out there in our portfolio are about 45, 46 day duration to expiration. Obviously, that kind of covers the gamut from everything from, coming into expiration in December's and then, those 70 and 90 day rights of things that just got written recently. And typically, we're looking to generate about 1% of the underlying equity price in cash flow for anything that we write. we're not going to go out there and cover Apple for 40 cents on a premium. That's just not enough to really entice us into that trade. So it's all about finding that balance of, how far out of the money, that cash flow that we're able to generate, and, especially in our fund, EQTIX, how much of a position to cover. So I think that's one, common misconception amongst, or misperception is it's all or none. It doesn't have to be all or none. You don't have to cover 100% of a holding. If you have 1,000 shares, you could sell calls against 200 shares, 300 shares, retain that upside potential on the majority of the position, still pull in some cash flow. That gives you a lot more flexibility down the road to, if you need to roll those calls out, you can ratio up. You can buy back 2 contracts, sell 5 at a higher strike to replace it, keep your cash flow positive. So there's a number of different characteristics to be mindful of, but I think mainly, duration, out of the money level, premium generation are the ones that we're primarily focusing on. And then I think that the others, protective puts, callers, really a lot of that comes down to just client specific goals. So we don't do any protective puts in our, EQTIX core value fund here, but we do have some custom client accounts where they have concentrated positions. They want to do hedging. And it really comes down to tailoring a hedge to what that specific investor is looking for. If they've got 90% of their overall net worth in one given equity, maybe they aren't too worried about giving up upside. They're just worried about the downside, seeing that portfolio really take a hit, get cut out at the knees. So maybe we structure a hedge accordingly. Or, maybe they're not so worried about the individual equities. They just think, hey, we're in a shaky market environment. I'd like to protect against downside in the equity market overall. That's where we might look at doing something like a benchmark hedge, getting into some SPX contracts or SPY contracts there. So a lot of it comes down to, kind of a math equation, trying to balance the objectives, that cash flow with keeping upside potential, or on the hedging side, finding those pain points, seeing how much are we concerned about that additional downside? How much upside are we willing to give up in exchange for putting a floor under ourselves here?
So, Nick, let me see if I have this correct. So you can't pick bottoms in the market, and you refuse to sell cheapy options in Apple. I may have to just end the show now. What are we doing here? What kind of content is this for our listeners?
Exactly. Nothing exciting.
Nothing exciting. If you're not selling nickel options on the bid, what are you doing with your life, Nick? There's no fun to be had at all out there. But obviously, there's a lot of different ways we could play with these different buckets, listeners, and these different overlays. We could obviously do many hours worth of show. And luckily for you, we have in the past. If you go into the archives, we've delved into each of these different buckets in much more detail. So go check those out if you are intrigued by any of them, including how we set up covered calls. We've done many episodes on those, including some recently, how we set up protective puts, and of course, collars. Mr. Matt, we were just talking about puts at the top of the show. This is an intriguing time, but perhaps the puts playing a little bit of a siren song right now. They're luring you in with that cheap premium, but perhaps not going to pay off the way people think. So this could actually be a very challenging time for people who are looking to perhaps do bucket 2 and bucket 3, which are the protective overlays and even the collar. So what are your thoughts on those two right now, Matt?
Yeah, I think it is a challenging time. So I went out and, as I do, ran many back tests, and I wanted to see strategies that performed well, obviously in 2008, 2018, and this year, because I think that we're going to be in kind of a grind bear market, and it's kind of, I don't know, it's a little bit surprising to me, but this longer term put calendar. So 450 days on the long, 130 days on the short, and out of the money. So it's almost like you're buying one of my famous garbage puts, but you're selling something against it. And there's a fair amount of premium you get. So you are effectively, you got still paying a fair amount of money. There's still Vega, but you have some theta against it to help you, protect you, and you have a little bit of Vega that you're selling. So that looked pretty good to me. As far as the calls go, we've done a huge back test, and so up on our blog, 3 million different combinations of popular stocks in the S&P, and what we found on that one is, first of all, it's really tough to do covered calls. You give away a lot of your upside. The way stocks tend to move is they move violently up, and that's your move for the year or something. So you have to be very careful with covered calls. But I think now with the skew, the calls are getting richer, and so and with the vol higher, these are the good times. So one of the things that we found is you have to get a lot of money for these out of the money puts. Like if you could get 10 delta, 15 delta, and get a high percentage. The option price to the stock price. Those are the times when the back test looks good. So I think it might be a good time for some covered calls. I'm usually not a big fan just based on the back testing, but now with the skew and the volatility and the fact that I don't think we're going to be jamming up, I think it's a decent time for that. And then doing something like put spreads or put calendars. On the put side. And, I think that's a good way to protect your portfolio, Mark.
Interesting. Like we said, many different ways you can go with this. And as you also mentioned, Matt, this is perhaps an intriguing time to be selling some of those covered calls, but also you have to be wary of the pitfalls, like giving away all of your upside. Nick, when you're not talking to us and you're not out there buying perfect bottoms in the S&P, you're out there writing a lot of covered calls for your clients over there at Sheldon. So what are some of the challenges you encounter day to day when trying to execute those overlays? Is it just something as basic as your clients are maybe a little bit reluctant to give away some of that upside for the reasons that Matt just laid out? Is it that maybe you're not seeing the income levels to really merit the selling of the options? I was joking before, but selling 40-cent options in Apple, probably not exciting or sexy to a lot of people out there. What would you say are some of the major challenges when you're out there trying to implement these covered call overlays?
Absolutely. I'd say one thing that you just mentioned is the violent up moves that we've had in kind of recent times, the choppiness of this market. I think that's been one of the tricky aspects, certainly at least in recent times here, of doing an overlay in this kind of a market environment. I mean, we just had, between middle of August down to the bottoms there in, I guess, October, November, 15, 16% drawdown in the S&P and then about a 10% pop. We've had some huge swings here. And if we look at some of the big names, Apple, they bounced from 130 up to 170 in a month and a half, 2 month period here between June and August. Those kind of quick, aggressive, violent runs are pretty tricky in the covered call space, frankly. I mean, if you're at 130 on Apple, you're not going to be selling calls up to the 160, 170 level with short duration. That's just too far out of the money to be in play. So that has been a bit of a tricky aspect of it. Like you say, people hate missing out on upside. So that's certainly something that they're very mindful of. It's a big pain point for investors. But I think the way that we've been able to manage that is, with elevated volatility, sure, it could be higher, but it's a lot higher than it was in, recent years anyway. And we're able to write options that are farther out of the money, still get attractive cash flow with a short duration, and then keeping coverage low. I think that's a big piece of it, is not getting greedy. When you see the market coming down like this, volatility goes up, premiums start to become a bit more attractive. Not going out there and covering more of a position than is prudent. Not going out there and kind of laying all your cards out on the table unless you need to. Keeping that coverage low, being conservative. If it makes a pop, you've got tools in the tool belt then to work things up. If it trades flat, trades down, you still harvested some premium. Staying on track for what our goals are, our cash flow generation targets, and just not being greedy in this kind of environment, not overstepping, taking advantage of the increases in IV and taking advantage of when the market does have these chops down to get a bit of a reset in coverage. When we had that run in Apple, we had more calls written when we got up to that 170 level than we did before. Then we get a pullback, we get some good expirations, and then going back to that conservative stance to be ready in case we do get another run.
All right, a lot to unpack there, listeners. Hopefully you enjoyed this overview of overlays, if you will. Again, if you want deeper dives into each of those buckets, the covered call, the protective put, the collar, the different ways you can play with all of those. And they are legion, listeners. Check out the archives and maybe stay tuned. Might get back to some of those a little bit later in some of the office hours, as now we keep on rolling right on into the earnings volatility report.
Earnings announcements can move markets, but what is the options market telling us about upcoming earnings events? Let's find out with the Earnings Volatility Report.
All right, everyone. Welcome to the Earnings Volatility Report. Another segment that was pretty much born out of the pandemic because I kind of strong-armed Matt into running all these numbers for our listeners. And it became a very interesting and insightful source of data and analysis of what's going on out there in the markets. And still, all these years later, Matt, is still really the only ones out there providing this level of data for people for free. I mean, you can go to Goldman, I'm sure, any big house, and maybe commission a study. They'll charge you a ton for it, A. And B, I'm going to guess it's not going to be as thorough as what we're putting out there for free for these folks, just because we like them, Matt. But Matt, you've been crunching all these numbers. We kind of just wrapped up the most heated part of earnings season. Obviously, we still have some names popping off, so it's not entirely done yet, but the primary weeks are behind us. And I think I can sum it up with 3 words, really, Matt, for this season, is that it was a banger. Would you agree, sir?
Yeah, I mean, we waited long enough, right? So we put this huge earnings reports together, and then COVID came, and the macro events overshadowed the micro stock movements, and so we didn't really get the big moves that we were looking for in a lot of the individual stocks for quite some time. But I think that's all changed, and I think it's going to be even more important as we start to look forward to Q4's January reports. We're going to get some visibility into what these companies are looking at for the next year, and I don't think it's going to be pretty. So one of the things that we do is we look at the earnings season, and we break it down into 6 weeks, because that's basically when 98% of the companies report. And we've been able to find some trends. We look at really profitability for straddle owners, and it's not that good in week 1, okay in week 2, getting better in week 3, and the best in week 4, and then kind of falls off week 5 and 6. But on average, it used to be about 99% you'd get back on your money for buying these straddles. Over COVID, it went way down. We were averaging in the 80s. So it brought the average down now to about 92. This earnings was 119, so 19% return on owning straddles for this earnings season. So that was a banger, as you say, Mark. And again, the week 4 was probably the biggest. I know we had a little bit of an anomaly in week 2, not too many firms reporting, but a big week 4 as we predicted. And I see a lot more upcoming for next earnings season. As far as this earnings season, yeah, as you say, there's not too many left. What do we have? NTAP and ITU. Intuit is after the close tomorrow. CRM and a few other stocks before or in the coming days. So, but where we usually have 10 pages of companies, now there's only 2 or 2.5 pages now. So not too many, just the stragglers as we prepare for the big event in mid-January, Mark. I think that's going to be the start of the decline of the market.
Interesting stuff there, listeners. If you haven't checked out the earnings move results, earnings season, and the newly added earnings trades report. So if that's not enough to seeing all the data, actually some interesting trades you may want to at least consider or just use for idea generation for your own purposes, tracking long straddles and long calendars out there. I think there's somewhere around 100 or close to 100 of each that we're tracking right now for your education and information out there. Check it out over there, theoptionsinsider.com. Like I said, can't beat the price. It's free, and it's some of the best data you're going to get on this subject. Nick, you mentioned earlier, only half jokingly, about selling cheap calls in Apple, but obviously Apple, and I'm assuming other large single names, are a big portion of your covered call overlays over there. So how big of a driver is earnings season in what you do, Nick?
I'd say it's a very big driver as far as the strategy that we employ and what options that we're writing. And with that earnings volatility coming in, that makes shorter duration options a lot more attractive than they are in a typical volatility environment. So I think that's a big component of our overlay strategy here as far as what options we're writing and when. I like to have options ideally expire just before earnings. Then you can roll out, take advantage of that earnings IV, hopefully be able to get a bit of a reset and hopefully sell some very short duration options. I mean, that's a big thing for annualizing better premiums is if you're able to get an attractive ride on a 20, 30-day duration that will drastically increase what your annualized premium generation looks like. And, taking advantage of that is something that I look forward to 4 times a year, frankly. I mean, it's a big opportunity, especially in the option selling world. He was just talking about straddles. We sell options is essentially all that we do. We're very rarely buying options, only in specific hedging cases. So when you get those specific names and those IV pops, it's just a good opportunity to sell options farther out of the money, to get more attractive rollouts than you otherwise would, to generate premium on a short basis. So it's something to plan around, take advantage of, not necessarily, shy away from. We're seeing some sizable moves, but if you, position yourself in a relatively, prudent manner, you're still able to go out there, harvest some premium, sell some contracts, and then get good cash flows without putting yourself into a bind if you do get a big pop on the earnings release. So definitely something to plan around, take advantage of, and look forward to.
And we always look forward to the buzz, so let's get to it.
Busy financial advisors don't have time to follow the latest developments from the options market, so we do it for you. It's time to get the buzz.
All right, everyone, welcome to The Buzz, the portion of the show where we break down all of the most compelling stories from the world of options. Maybe you missed because you were busy out there dealing with your clients, which is job number one at the end of the day. And the top story still when it comes to the world of options, one we've been discussing and debating pretty much all year long, is can the options party continue? Can this tsunami of options volume, can it continue? And so far, for this year, the answer has been a resounding yes. We are, as we record this, listeners, a couple of days away from getting the November numbers from OCC. So we'll have a clearer picture in a couple of days of how the year is stacking up. But of course, November, not always a rock'em sock'em month when it comes to volume, because of course we have Thanksgiving off. We have a half day on Black Friday. So that's always eats into the volume numbers a little bit out there. So I wouldn't expect November to be a top 3 month. But again, this is a crazy, tumultuous, topsy-turvy year. Anything could happen out there at the end of the day. Of course, October was a top 5 month out there. It was the 5th busiest month in the history of the options business. Overall volume up over 10% on the year. In fact, we had our buddy, the Flow Master, Mr. Henry Schwartz, who will be joining us tomorrow, listeners, on our pro Q&A session. So if you're on the pro side, make sure you get those questions in now for the Flow Master. But he chimed in one of our live chats recently saying he thinks the year is on track for a little bit north of 10 billion contracts, about somewhere between 10 and a quarter, maybe 10 and a half billion, which would indeed be a new record. And of course, looking at the numbers from October year to date, ADV, average daily volume, listeners, was up about 5.6%. So that would indeed put us on a track to meet or indeed exceed that close to 10 million contracts, 10 billion contracts that we hit just last year. That seemed like an outlandish number last year, and here we are going to probably exceed it. Nick, this has kind of been the story of the year, story of the last couple of years, really, in the options market since the onset of the pandemic. What are your thoughts on this just ongoing tsunami of options volume, and can it continue, sir, through the end of the year?
Absolutely. I think it's been great to see increases in options volumes like we have over the last number of years or even couple of decades. And whether or not we'll get the seasonal increase here through the end of the year or not kind of remains to be seen. But I think that we will continue to see increasing option volumes in general moving forward. I mean, especially with the advent of better trading platforms for people to trade at home. I think people forget it was only back in 2001 that we were still trading in fractions. I think 2007 is when they created weeklies on the SPX. So a lot of this is still fairly new, and it seems to be still growing in popularity. Like you say, the COVID era brought around meme stocks. A lot of people sitting around at home looking for something to do to entertain themselves. So, increases in retail trading, increased acceptance on the institutional side. With advisors, we're seeing a lot more advisors coming in that are, aware of options, implementing them in their portfolios and, pitching them to clients. So I think that we'll continue to see those big increases year over year moving forward. Where we hit a kind of natural equilibrium level remains to be seen, but I think it's a good thing to have more people trading them, more people interested in them, and those volumes keep increasing. We're getting better liquidity and just getting more interest in general. It's been a niche space for a long time, and it's just starting to kind of come into the mainstream. So,
yes, we had a guest, I think it was last year on the network, talking about this exact topic, saying something along the lines of, we've always wanted more people really to join the options market. We just didn't know they were all going to join at once. And that's pretty much what we've had since the pandemic. And so managing that has been a fun challenge. These are first world problems for a lot of people out there. We, of course, see that anecdotally on our network with new records every month in terms of listenership out there. So more people are coming to grips with the options market every month, which is a great thing at the end of the day. Matt, what are your thoughts? Like I said, this has been a topic you and I have been discussing and debating for years now on the show, and certainly coming into this year, it was the hot topic. Can we possibly match or even, dare I say it, exceed the record numbers from last year? And it seems like so far, Matt, I know you were a little skeptical for a lot of the year, but it seems like so far, at least coming into the end of the year, it seems like the answer is probably yes, sir. What say you?
Yeah, I think it's a good point that Nick brings up about better liquidity and better tools to trade. And also, I don't think we could overlook this, daily zero DTE. I know I had to say it first, Mark, but, that's attracting a big crowd. And now it's not just SPX, but it's a lot of other ETFs and such. So, I mean, they're adding good new product out there. And that's bringing a lot of volume in the market itself, just, moving and a lot of uncertainty. And that's all helping. My point was that the Fed tightening was going to take some money out of people's pockets for trading. That probably has had an effect, probably not as big as the other ones that we mentioned. So, as far as our business, we're getting more and more people coming in. You said the same. So there's kind of ancillary evidence that, just getting more popular out there, and people understand it. A lot more education. Thanks to the Option Insider Radio Network and others. And, it's a good thing to see, Mark.
You mentioned zero DTE. That is the subject of one of our many listener questions. Let's get to those now. A little bit of the old office hours.
It's time to answer your pressing questions about options. It's time to start our office hours. You can become a part of this segment by leaving a question on theoptionsinsider.com, emailing us at questions@theoptionsinsider.com, or via social media at twitter.com/options, facebook.com/theoptionsinsider, or stocktwits.com/optionsinsider.
All right, everyone. Welcome to the office hours. You folks are great. You wait so patiently for your answers. We'll get to as many of you as we can. I just want to sneak in here really quickly. This poll we just did last week, because it actually was inspired by a suggestion from Matt. We asked you guys last week, we spent much of last week hovering around 4,000 in the SPX, but everyone wants to know, where are we heading next? So it's time for you to decide the answer. Quite simply, which level will we hit first in the SPX? 3,000 or 5,000. Like I said, Matt kind of hinted at this poll, so we put it out to our audience. And Matt, the overwhelming response, 68.3%, said 3,000 is coming first. Look out below, only 31.7% saying we're rally-hoeing all the way up to 5,000, sir. Are you surprised? Is that what you expected? And what are your thoughts on these somewhat interesting and perhaps controversial results, sir?
I think this is what I'm saying. This is the most anticipated bear market that I've been around to see. A little worrisome too. Wall Street climbs a wall of worry, and I think a lot of people are expecting it to go down. I don't know. I feel like we're going to break out up, and we're going to get into the 4,000s one more time in a big way, break out from this downtrend. But I think 3,000. I agree. I'm a little shocked that it's that big of a percentage of people leaning 3,000. But again, I'm not real shocked. But I think it really shows how people feel out there. There's a lot of bad news, but again, the market just seems to drift higher, Mark.
Yeah, a lot of people chiming in on that poll, and a lot of them clearly feeling bearish. What do you think, listeners? Does that make you want to fade that? I don't know. Nick, what are your thoughts here? Nearly 70% of our audience saying we're heading down. Does that make you want to fade it? Like, Matt, are you being contrarian?
I don't think I'm going to be the contrarian and say that we're going to 5,000 first. I think that, like Matt said, it's one of the more anticipated bear markets that we've seen in a while. And I think that, with those kind of expectations and that kind of perception out there, again, 2/3 of people thinking that it's going to be down to 3,000 before 5,000. People might be selling into this strength. We get these kind of pops, get up to a 4,000 S&P. People might be selling into that. And, echoing some of his earlier comments, I think that next year things are going to be, getting a little bit worse still before they end up getting better as far as earnings, as far as the overall market environment. So I think that the majority might be right on this one.
All right, let's get on into some of your questions, listeners. First, this is a very timely one from Chris Allen. We were just talking about this on the show. Chris Allen wants to know, why is it so hard to make money with long puts as a hedge in this environment? It seems like when the market drops, my puts for my clients don't make as much money as I expected when I bought them. Any tactical advice from the pros for managing puts would be welcome. Well, Matt, you were just talking about this a few minutes ago. You kind of touched on this a little bit already, but Mr. Allen here sounds like he's having a hard time. He's buying puts. They're not doing what he's expecting. Any, as he puts it, tactical advice for him, sir?
Yeah, I mean, this is what we've been talking about for a while now, is that, when we're in this kind of a bear market and a lot of people are loaded up on puts, they're going to be getting rid of them as the market goes down, and it's going to have almost an opposite effect. I think, we'll still get a bit of a pop involved, but not what you expect. So tactical advice is, selling something against it, and still maintaining the amount of money that you need to protect your portfolio. So with that, to me, means calendars where you sell on either the same strike or a lower strike as you're needing to protect yourself, and buying a longer dated option. That could be effective. As I talked about earlier, you get some theta and a little bit of vega offset, and you buy yourself some time. And then put spreads where you're long. You could get a higher strike for less money than if you bought a put on its own. So I feel for this guy. But I think that's the nature of the market right now is the puts aren't going to be as explosive when the market goes down. When people were, when it was a bull market and you'd get a sell, they were unprepared and they'd be buying, they'd have to go cover and pay whatever it would get for a put, and that would really drive the prices higher. But now I think it's a little different. So, yeah, it's a different type of environment. You have to be a little bit more tactical, and that to me that means put calendars, put spreads, and even some overlay calls or some overlay call spreads. Mark.
Nick, anything to add there? I know you're more of a covered call guy, but anything to add on the tactical side for managing some puts in this environment?
Yep, I would echo Matt's points there. I think that spreading things off, I think, is a key tactical approach here, as far as not just going out there buying long premium. Spreading things off, either just doing a vertical or a calendar spread, like Matt was talking about earlier, going farther dated with those that he's buying, shorter dated with those that he's selling, getting a little bit better theta decay on the short position. I think that's a better way to approach it oftentimes than just going there outright and just buying puts as a standalone position. And then also, maybe looking at, on top of that, laying in a few covered calls, going out there, doing some kind of a spread, vertical or calendar, reducing the overall cost up front of putting on that put position, and then maybe sprinkling in a few covered calls, help mitigate that cost in case it goes the wrong direction for that put hedge and you're seeing the market retrace back up. Take advantage of both sides of the equation as far as generating premium to help pay your way out, selling puts against those that you're buying.
All right, we're coming up against it here, so let's jump to this one here from Entel, because Matt was just talking about zero DTE. It's all the rage, listeners. This question from Entel says, I've heard that over 40% of SPX volume these days is zero DTE options. Is that correct? And is that just all retail, or are the pros doing it too? What are your thoughts on that trend and its impact on financial advisors and the options market? Yeah, this is a fascinating trend there, Entel. Great question. It's one that we've been talking about a little bit here on the network of late. I think everyone has been surprised by just the rapid adoption of these products. Obviously, they've added more expirations in major indexes like the SPX, so it allows you to trade a Monday or a Thursday or a Wednesday option if you want, or spread them against each other. And what a lot of people are doing is coming in and making trades that we used to see more on the futures options side out there in, let's say, crude oil or metals, which is putting on trades on the same day as expiration or close to expiration, whereas usually in the equities in the past, everyone was just harvesting premium all day long. But now people are putting things on the same day of expiration, which is, I wouldn't say unheard of, but a very rare thing. People used to always unwind their positions on expiration to avoid all the madness that unfolds when your gamma and your theta explode to near infinite levels. It's very difficult to manage from a portfolio perspective. So you'd rather avoid that and move on to your next trade. But now people are doing the opposite. They're actually going and seeking that out. And you're right, Entel. It is on some days north of 40% of volume in big products like SPX, which is insane. When you say that out loud, a lot of the pros are stunned at this. I mean, people have been looking at this and saying maybe it's retail, but no, a lot of the large funds are starting to develop strategies around this, including a lot of very near-dated premium harvesting. We've been seeing this for a while in options on the E-mini over there at S&P. People just line up to sell 600, 800 handle out of the money puts out there all day long and all week long, including the day of expiration. But this is a newer phenomenon in products like the SPX and others. So intriguing stuff. Nick, I'm curious for you in the time we have remaining here. What are your thoughts on this growing trend of zero DTE? Is this something that you folks are thinking about adopting over there at Sheldon, or is it just too much management, too much effort for too little gain? What are your thoughts on this just explosion of all things zero DTE, Nick?
Absolutely. Yeah, certainly not something that we're looking at adopting. We're not looking at the zero DTE range for anything that we're trading into. You know, I used to, back in the day when I was on the options desk, do what I called front day trades, where I'd wait till, last couple hours of market and do exactly this, trade into options expiring that day. It was, entertaining. I wouldn't call it investing so much as either trading or speculating, but I think that a good amount of it could be coming from retail folks. But as far as the institutional side, it's not something that, Shelton's looking to get into. Could see some folks, developing premium harvesting strategies around that, but that's a lot of trading. With our SMA strategies and the fund, everything across the board, we've usually got probably 20,000 line items of options in play at any given time. Trading into a bunch of stuff that's going to expire today, just, more opportunity for something to fall through the cracks and not necessarily enough premium out there to harvest to really make it worthwhile, at least not for what we do currently.
Mr. Matt, same question for you. Obviously, this is an area that has intrigued you, where people are hitting us up now about zero DTE, butterflies, and you name it. It's definitely the hot trend. Are you all over this zero DTE trend, sir?
Yeah, actually, I am. I'm addicted now. Of course, as a floor trader, I loved expiration. It's great money to be made. Obviously, it's a lot different on the other side of the trade, but people want to see their outcomes of their trades, and people want to, if you go, I like to watch YouTube traders and see what people are touting out there. And there's a lot of zero DTE selling, way out of the money puts in the morning, put spreads, and maybe 10-to-1 risk or something like that, and getting out of them after a small profit. It's kind of funny to see, but you get a lot of those, and a lot of my clients are looking for this type of information, and we're able to decay the theoretical values, so you could help show where if there's any edge anywhere, and we have intraday signals, and we watch the volatility, and that helps with some of the trading triggers, and so you have to, I think, automate some of this stuff, because there's so many moving parts, and it's just like a longer expiration condensed down. So you have to make all these decisions, in a short amount of time. So, but people like it, and that's an amazing stat of the volume. So, I think for financial advisors, it's going to be difficult to implement, though, because you're only one person, and it's difficult to you have to have some automation. And that's what our front end aims to do too. So, if you have clients that want to get in on some of these zero DTE trades, you're going to have some methods to get them into their accounts, trade them, and get them into their accounts. And I've seen, and talked to some of our technology partners, and there's a lot coming on that front. So that's, I think, the only way you could even think about doing it as a financial advisor, Mark.
All right. That music means we've come to the end of another fun journey through the world of advisors and options. I want to thank our guest, Mr. Nick Griebenow from Sheldon Capital Management. Nick, before we go, if folks are intrigued, they want to reach out to you to discuss any of the topics we talked about today, or maybe learn more about what you folks have going on over there in Sheldon Capital Management, where should they go? What should they do?
Yep, they can go check out our website, sheltoncap.com, and if they have any specific questions, my contact info is on there, and they can absolutely feel free to reach out.
There you go. Check them out. And Mr. Matt, they want to see your new dashboard or all the other cool stuff you have cooking. Where should they go? What should they do?
Yeah, orats.com, the best place to start. We have PDFs and a lot of things that you could read there. We have a YouTube channel, shows you going through the product. We're coming out with a ton of stuff, so it's going to be really exciting. We're tying into brokers, bringing positions in. We're going to be able to trade through the brokers using our scanners. We can make signal builders and indicators and systematic strategies and do all this stuff. And we've just released today our indicators explanation. So we explain 800 different indicators. So you could, when you're timing strategies like, 5 delta 90 day to expiration, compared to the RSI of that reading is in a certain spot, you could have an alert go off. It sounds kind of weird, but that some people do that and back test those. So all sorts of stuff like that. So come by orats.com, and I'm Matt at orats, MATT at ORATS.com, Mark.
There you go. Check them out, Matt at orats.com. Also, give him a follow on the old Twitters at Option Rats, all one word. Pretty memorable handle. A lot of great data coming out there in between episodes of this show. And of course, you know where to go to learn more about our friends over there at the OIC, the Options Industry Council. It's just optionseducation.org. Great place for studies and data and research and educational content, everything you might want to use as an advisor to arm yourself with more information about how to use these options things for your client. That's going to do it for us on the network today. Back again tomorrow with a great pro Q&A session with Mr. Henry Schwartz, the Flow Master himself, as well as some great educational content. It is Education Wednesday, after all, so Options Bootcamp, Options Playbook Radio. If you like the educational side of the Advisors Option listeners, you should be A, subscribed to the full network, and B, checking out Options Bootcamp and Options Playbook Radio. Matt even made a guest appearance on Options Bootcamp recently, so check out that show. That one been running for over a decade, hundreds of episodes at your disposal, and growing more popular by the day, it seems, out there. So check out that one if you haven't done so yet. And of course, we'll be back again very soon, another episode of The Advisor's Option. Stay safe out there, everybody.
Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Option Research and Technology Services. ORATS is your source for options backtesting. It's where you turn your ideas into results. Founded on the floor of the SIBO over 2 decades ago, ORATS is a full-service option research firm focused on helping you develop options strategies in line with your investment objectives. With a state-of-the-art backtesting platform, scanning, and implementation tools, ORATS offers end-to-end option strategy development, making the whole options trading process easier. For information about backtesting, scanning options data, including dividends and earnings, visit ORATS.com or email Matt Amberson at matt@orats.com. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.